Hello, Culture Matters Podcast. I'm so excited to introduce you to our guest and my co-host today. Before I do that, here is a quote just for this podcast. We lean heavily on common sense and how we approach things. Jordan Cvetanovski is our guest today, and my co-host Aleck Arena for the Value Investor Series. If you haven't listened to episode 857, season 72, go there after this episode to listen to our guest, Jordan Cventanovski. Many decades understanding value investing, background in engineering and economics, and worked with some pretty amazing organizations throughout his tenure, and even an organization that was a few billion AUM to many tens of billions. And today, founder of Pella Funds, a global investment firm that specializes in a bit of common sense, or maybe as Einstein put it, uncommon sense. It's something
Yeah,
about uncommon.
it can be.
Aleck, thank you for joining us. And
Awesome.
Jordan, thank you again for having you back. I'm excited.
So,
Thank you very
Jordan,
much for having me.
sorry, Jordan, last time we went into, we did get a bit deep. I feel like we skimmed the surface, but we didn't get as deep. And we talked about you having stop losses on cyclical businesses. And we talked a bit about Nova Nordics and your time and the after the global financial crisis, effectively. But
Yeah.
we didn't talk too much about your process. We skimmed it a bit. It felt like there was some real nuggets the audience would want to listen to there. Yeah, if you just want to
Pleasure.
expand anything on your process, and we'll let you have the floor and ask questions from there.
Okay. Wow, that's the broadest question I've ever faced. I'm going to have to kind of put some bullet points on that one and kind of double click on all those things. The question is, where do you start? So when you decide to invest, and I want to underline the word invest, you have to decide what your aims are, really. What are you trying to achieve? If you're trying to achieve short-term gains, you're trying to kind of keep up with what's happening in the short term, then the process is, inverted commas, process is very different to what we do. And in some cases, that short-term mentality, short-term focus really can do you a lot of favors. And one of those things is momentum trading. So if you talk to someone who momentum investing, so someone who invests in momentum, they'll lean heavily on quantitative methodologies to tell you what's moving up, what's expected to move up, all these kind of things. And we're in the midst of one of the biggest momentum bull markets we've seen probably since the dot-com days, and maybe 2021, prior to the collapse in those growth stocks. So where we kind of live, our process lives, is more in the long term. So we think that the way you win and the way you should invest is, and the way you can actually analyze things, is longer than 3, 6, 9 months. You have to take a view on a company in the longer term. So we're not in that hedge fund short-term kind of thinking kind of sphere. We're in the longer term thinking. So we want to hold businesses that are high quality, that are attractive from a valuation perspective. That means we think we can make more money than the market offers in the long term, for a longer period of time. So we have this time arbitrage aspect to what we invest in. So that's important to outline from the beginning. What that means is, if you stay true to that process, you have to accept that once in every, 10 years or 8 years, there will be a market environment where you will question your process. You will say, okay, I'm underperforming here. What is happening? The market is running away from us. All these stocks like Palantir is a good example at the moment, trading on 200 times revenue. Should I be changing things? Should I be looking at different kind of ways of investing? And this, initially you think, well, this is just silly. Then it keeps going, and at some point it keeps going further, where you just think, well, the market's broken. I have to adapt and change things. But then you have to go back to within yourself and you say, what am I here to do? I'm here to invest for the long term. Therefore, I have to basically lean on my process even more heavily than ever before, which is what we're doing right now. This has to mean that if you believe that common sense, which is what was described earlier, if you think common sense governs the universe in the long term and hence financial markets in the longer term, i.e. people talk about mean reversions in valuations and things like that. I would like to move focus to mean reversion to common sense. And if you think there's mean reversion to common sense, then when your common sense approach isn't working, that tells you that you should, in our opinion, should tell you that you should lean even more heavily on that, because eventually it will come back. So hopefully that makes sense as a preamble. Now we go into what do we define as common sense. We think it makes sense. First of all, let's go to the type of companies we should invest in the long term. We think it makes sense to invest in companies that have quality, and quality is a term that's thrown around so readily these days. But for us, what quality means is a company that has history, that has proven itself over time. It has a product or a service that the world and society or the consumer needed 3 years, 5 years, 10 years ago, and we can see a world where the consumer will continue to need that same product or service 3, 5, 10 years from now. So that is, for us, a good starting point. Another indicator of a quality business is one that grows. So although this is a value investing related podcast, I would say that there's many different ways to talk about value. Some people buy, again, within that value framework. You must have had guests on your show that talk about, hey, we buy this company, we strip it for parts. The sum of the parts of what's left is worth more than what I paid for. That's great. We don't do that. We don't do distressed debt. We don't do a turnaround situation where a company has been so bad for so long, suddenly a new superstar CEO comes in that can make things better. We think the probability of success in that strategy is much lower than betting on something that's already worked in the past. And if you can see what's the short-term issues that are affecting the company, and you can see past them, then that would be a much better way to invest. So we think that a company must grow. Why? Because if it's growing, that means that they're doing a good job. Simple as that. And I mentioned this in the previous podcast, I believe. So growing, good history and good quality, good culture within the company of how they will grow. So these are the things that define a quality company for us. Now, a lot of people will agree with those kind of things. Where this job becomes infinitely harder is where you try to find that union of finding a high quality business. And I believe many people can identify quality business. You pick 10 people off the street, they'll say, hey, that Apple company must be pretty good. Buy their iPhone every 2 years. That's a high quality business. Where it becomes harder is where you decide on when what you're paying for that business and for that quality is attractive in the longer term. And that's where you can get a disconnect. That's where we fall into the value side of the spectrum of growth investors, heavily into that, where others might lean heavily on quality. I mean, every time the market goes up exponentially, people say we invest in quality and that's why we're doing well, but quality at what price? So if it's quality at any price, let's call it QAP. It's different to quality at the right price, right? Now, you can justify anything. You can say, well, I read a comment by a high growth manager once saying, well, I invest in companies that grow 60% per year. The price doesn't matter. It makes me a quality investor because through their growth, they become cheap. Therefore, I'm buying value companies. I mean, fine. But then again, you don't take into account the risk that is inherent in that bet in order to get to that future future level that you're
Extrapolating.
expecting. So it's, if think of it as three unions, three circles that need to meet in the middle, which is the quality of the business, the valuation of the business, and the risk that you're taking of the business. When we find that union in a certain company, where it falls into that space, that's where we get very excited. And we get excited for the 3 to 5 to 7 year term, but we accept that in the short term, the market might not be interested in that particular company. So that is basically the ideal situation that we invest in. So that's the process. That's where we want to have at least 60 to 80% of the fund invested in those, what we call core businesses. And sometimes that can lead you to be a little bit more contrarian than the market. Sometimes you go along with the market and you think, well, I think everything is appropriately kind of valued at the moment, so we may as well go along with it. But at the moment, what is happening in this particular market, in this particular point in time, is that we're starting to look more and more contrarian than where the indices are leading us into. And we can talk, and we maybe should talk about why this is happening, and that is, I'll have to refer to passive investing and a whole bunch of other things that are driving this kind of herding into these top 10, 15 companies, big companies in the world. But for now, I see it as a tremendous opportunity. Even though the markets are hitting all-time highs, I said to a client the other day, I think, or one of my team members, I said, in my 25 years managing money, I've never seen a situation where markets are so high, yet I'm seeing so many opportunities. And that both of those things can hold true, because the market is now so much about 15 stocks. And if you look away from the market, by definition, you know, there's many other companies to look at. So you can have both. And I'm pretty astonished at how many interesting companies there are, very interesting valuations.
Can the passive investing phenomenon unwittingly disincentivize competent capital allocation of the largest companies?
Yes, absolutely. In my opinion, it is what is happening, and I can give you some real examples. So just to rephrase your question, I guess what you're saying is, does passive investing en masse create a situation where you don't get proper price discovery of a company, right? And the answer to that, in my opinion, is yes. And I can give you some examples. An example is something like Apple, for example. Apple is one of the top 15 companies on the planet. If you look at Apple, it hasn't actually grown that much at all, and not expected to grow that much at all. We're talking 2-3% per annum. Now, when I first bought Apple in 2015, it was our biggest position. It was on 11 times earnings, growing at similar kind of pace that it was now, and expected to grow a bit faster. But now it's on 30 odd times earnings, so 3 times as expensive we don't look at P's, but for this purpose, I want to give you some numbers. It's much more expensive for a lot less growth. So how did this happen? It can only happen when, you know, they've got tremendous amount of cash flow coming out of the business. They're doing a lot of buybacks, and in addition, you've got 60 cents to every dollar basically being invested in a passive way through one index or another, but most of them are, let's say, global or S&P kind of major indices. And that means that passively, without thinking, money is just allocated directly into this business. So you know how share prices work. When there's more buyers and sellers, the share price goes up. So I would argue that there's situations, and for several years now, that Apple isn't where it should be. And the reason it is that high and continuing to do well is because there's just more buyers and sellers. And that is due to the way indices have become so dominant, and passive and ETFs has become so dominant in the market. So I think there is a danger of that. I'm not saying it's everywhere, but I do think if you see it on a micro scale on one or two big companies, you can imagine it affects the whole complex and much more the bigger companies. So there is an element of that, and you have to think, well, shouldn't I take that into account when I'm investing? The fact that if I buy a big US company, I'll always have a buy behind me. That is a valid argument, and that is in a way you could argue common sense, but that clashes with the idea of investing. So either you're an investor or a speculator that you'll keep getting more flows buying your stock. Because let's not forget, in my mind, an ETF or an index is essentially just another fund. I've got 30 odd stocks in my fund, and S&P 500 has 500 stocks in that fund. And the difference is that fund has 60% of all, whatever the number is, of all people investing, buying into those stocks. And I have a lot less. Okay. So that's what makes a difference. Yeah.
I want to draw an analogy and get both of your insights on this. So like in America, if you looked at GFC,
yeah.
What part of what underlie, if I understand correctly, underlie that was those in the US that didn't necessarily qualify for the ability to repay their loan at the bottom of it were getting into loans. How that eventually trickled throughout the world is a whole nother part of the conversation. But at the root of it, it was those that otherwise wouldn't have had the opportunity to get the loans based on income, job, and the core values that come with that level of socioeconomic or cultural level up or whatever.
Mm-hmm.
Isn't there an interesting analogy in the fact that because of technological advancement today, and I'm going to use this term, and I don't mean this condescendingly, I mean this in an investment standpoint, unsophisticated investors have access to homes, not literal homes, but the metaphor, to investments that they otherwise would have never had decades ago. A certain class of human being that the intermediary between those human beings in the past was only the financial advisors representing the financial institutions. So let's say, for example, there's an event-driven crash in the world. The institutions that are closer to the knowledge source, they get out, so they sell, high. The unsophisticated investor, that there's no intermediary, there's no financial therapist between them and their money, they're going to catch the falling knife. Like they're not going to hold, like all these books on passive investing, they all say the same thing. Don't sell, hold on for dear life. But the reality is most people aren't going to hold on for dear life. Most people are just going to sell. They're going to buy high and sell low. So if you take the, so I know I'm going into it, but I'm trying to alliterate on an analogy. Like, could there be, and this is me saying this, I'm not putting anything in your guys' mouth, but could there be an analogy between the global financial crisis where a certain class of people, I don't like the word class because it could be misconstrued, those that otherwise didn't have access to a certain asset class get access to it without the regulation and compliance, and ultimately that was a bad idea. So the analogy would be those that wouldn't or otherwise have access to this asset class now have access to it. And when there's eventually an event, that could the institution sell, and then they would follow, and that could disintermediate the entire thing. All right, what are your thoughts?
I think there's a herding mentality again, which is effectively the problem, because in the lead up to the global financial crisis, you had middle-class people herding into an asset class, and ETFs have created a similar situation, the way you've talked about, Jay. And it seems to me like it's also a bunch of middle-class people which are allocating to ETFs. And as Jordan's touching on, they're effectively blindly allocating.
I think you can
comment more on it. Sorry.
Yeah, look, I would separate the question in two senses. One is, does it make sense to invest in your own house long term? Probably. Does it make sense to invest in shares long term? Probably, yes. Both are yeses. Does it make sense to buy something and hold it for the long term? Yes. I'm sure if you bought a house before the GFC, what mattered most is what kind of house you bought and what were your finances like at the time. And if you bought at the right place at the right price, you still would have been okay during the GFC. If you bought at the wrong place at the wrong price at the wrong time, then that would have really hurt you. So similar, if we wanted to take that analogy into the markets, the question we're having here is not to the same extent, but people are exposing themselves to markets. Is that a good or a bad thing? I think that's a good thing. That's fine. Equities in the long term should produce good results. However, the question is how you get that exposure. And I do question a situation where you have 10% of what's supposed to be they call it a diversified holding, having an ETF. But actually, if I look at the exposure of one of these global ETFs, I would say that much more concentrated, and in my view, much more risk than you would get with a 30 stock portfolio if you think about where you're getting the revenue streams and what kind of exposure you have. So what I'm saying is the more people get involved, like Aleck mentioned, the more it rewards those big companies and it rewards momentum. So something that does well basically feeds more into that. So that becomes kind of a snake eating its tail, and it gets bigger and bigger and bigger. But at some point, there is the danger that you are stuck with 40, 50% in technology companies. Is that a good or a bad thing? We don't know in the long term. It could, to me, it feels risky. And then the question is, what happens when the herd looks the other way and starts going out the door again? So that is the risk. I do think that when Buffett probably made that comment, or someone else made the comment about ETFs being the best way to get exposure to markets, it was probably true back then. I just wonder at what point does it become not true, i.e. when we reach 70, 80% of all investments going into passive, does that really make sense? Is that really investing? Especially because we've seen the effect of that. It just feeds into those larger companies and you get this inefficiency, in my opinion. So I do think there's dislocation, but that creates opportunity for people like myself and my colleagues who try and pick stocks in these markets. It's made the job harder, but I think eventually this will even out. I don't know where it will even out or how, but we're reaching that point where it's gone too far in my experience.
Hey,
So
what insights do you have on so like the everyday listener that is asking themselves, how do I invest? There's a theme around, it seems to be a theme to the layperson on looking at fees. So like what comment can you make on fees versus risk? Or because one thought I had was how if the person that's saying, let me just do the passive way because it ultimately is going to beat the fees, what degree are they weighing risk into the conversation? Risk, the risk that they're, by not having a third party involved to be helping them build their wealth.
Well, I haven't thought this through, but I'll think it through as we discuss this. But if you're buying an ETF, which is supposed to be a direct replica of an index, and you're trying to beat that index, it's mathematically impossible, right? So if you buy all those stocks one for one, as the index is prescribing them, as soon as you pay a fee, you're guaranteed to lose that fee over time. So you will underperform. You're guaranteed a loss, an underperformance versus the benchmark. When you invest in an active manager who says, hey, we think we can do a better job than this benchmark, they charge you an extra fee because they're doing a lot more thinking. It's no longer just, mindlessly buying a bunch of stocks that are determined by some set of rules. The fact of the matter is, in the long term, if you're charging those fees as an active manager, you have to justify your existence. So you should be beating the benchmark, right? So over 3-5 years, you should be beating the benchmark. So anyone that invests in active managers like ourselves and others should take a longer term view, because by definition, if we're taking such a position of 30 stocks that are so away from the benchmark, there can be periods where you underperform, but you should deliver that in the longer term. So I think fees can be too high. I mean, we, for example, I believe we charge one of the lowest fees in Australia, and if not globally, for a global fund. And we've always said that fees shouldn't be an impediment to someone investing in an active manager. But we have to deliver. So if we're underperforming for a year, we have to, over the next 3 years, we have to look to get that back and then some. And that is a profile of an active manager. At the same time, you shouldn't blow up. So when we underperform, ideally we say we might not make as much money in a bull market, but we'll make it back over the long term. We shouldn't be going down more than the market when it goes down. So there's a lot of intricacies here,
I
which
want your
will
thoughts,
take more
both
than
of
an
you
hour.
guys. Well,
Yeah.
but this is like, as a consumer, right? Someone that's
Yeah.
wants to be right. I'm as the consumer in this, not the investor like you guys. The fear is
Yeah.
like, okay, obviously you want your money to grow, you want your wealth to build over time. And I'm thinking of the culture now, right? The culture of the whole machine. It's, what world is it where the customers don't want the company that they love their products and services to make money? It needs to make enough money to be able to continue to make the products and services. So if we have a culture where the whole culture of the consumers, like our listeners, are saying, we don't want to pay any fees, to me that's like saying, I want to go to the movies for free and get my movies. I want to go to the movies for free and get my movies. And I don't know how you're going to pay those people that are giving me the popcorn. I don't know how you're going to pay those people that are turning the projector on. I don't care either. But I just want a free movie. But then you're never going to have any movies.
So, but that's the thing, Jay. They've had their cake and eaten it too. That it has happened. They have paid almost next to zero, and they've had the returns that they hope for. And that is the thing that is amazing about this market. You've had all these champions like Nvidia, Microsoft. It has created and low interest rates. Everything that could have gone right for the markets has gone right. A lot of it paid through. There's a little bit of debt in the US, which there will be a reckoning for at some point. But the fact is, if you were paying next to nothing, you got a lot for it. So of course you give more, you feed that monster more and more. They're actually, consumers are being rational. But you're right. So harking back to the GFC, months before, 3, 4, 5, 6 months, I remember started selling out of all the banks and property companies out of my funds, and that was very much against the run of play, because back then banks and financials were the biggest component of, let's say, European indices. They were 30-40%. So selling all of those down, for me as an active manager, made a lot of sense because I saw a lot of risk. Now that's not what you get by paying little. That's when a manager that is on their game will make a decision. And right now we are shifting money away from very expensive technology stocks and other companies, and we're shifting it into cheaper sectors like healthcare and other places. And that might seem brave or stupid, depending on how the next 3 years play out. So that's what I'm getting paid for. But yes, sorry, go on, Aleck.
No, all good. You touched on just there that pre-global financial crisis, you were getting out of banks and financials. And I just think, can you touch on that? Our audience probably doesn't know that banks and financials are actually cyclical businesses, because I know how they're currently priced in Australia. It would be fair to say that the retail investors haven't figured out that banks are cyclical assets. But can you please touch on that to our audience?
Yeah, okay. So this is a bit complicated. So let's start with the most cyclical of banking businesses. That would be a bank in an emerging market, for example. As you know, banks make money by borrowing cheaply and lending at a higher price, that they keep the spread. So in a situation where interest rates are low, they make less money. When interest rates are high, or the curve allows them to make more money, they make more money. So when it comes to, so for long periods of time, no matter how good they are, they can struggle. And that's what we had post GFC, when interest rates went to zero, the banks, if you look at European banks, they went to a P of 7, 6, 8, really, really cheap valuations. No one wanted to hold them because there was no prospect for them to make more money. When interest rates went up, they started making more money. And you saw that in the last year or two, banks no surprise, banks in Europe and US have done really well in terms of share prices. So we treat them as cyclical because a lot of what they can achieve remains in the hands of central bankers, the way the economy is progressing, and that to us is out of their hands. So the more that is out of the hands of a company, the more it pushes it into cyclical territory in our mind. So an example would be something like a Nestle. Let's pick a boring business. They just have to create a new packaging for a water or a new Kit Kat or whatever, and they can just keep growing their business over time, no matter what happens. People will eat, all the rest of it. But a bank basically feeds on what the economy throws at it. So that's why we think of it as a cyclical business. That means that when we look at a bank, we've got 2 Indian banks, and that is it. When we look at a bank, we really focus on how much is in their control, what can they do within that, and then we have to spend maybe 50 or more % of the time on the actual economy and things like that, which is not about the company, it's about its operating environment. So that's why we think it's cyclical.
Thank you so much. Yeah, not a lot of people would have known that, and that's why I was kind of laughing there because as you said, it's out, when it's out of the company's control, it does make it cyclical. But sorry, just to touch on what I'm double clicking or circling back to your point before, that you said the market's hitting all-time highs, but you're still finding opportunities. So is your cash balance not going up, it's still staying about the same? It's just finding opportunities?
No. It's actually historically quite low. We're quite excited about some, as I said, our exposure to healthcare is the highest it's been in many, many, many years. We're talking over a decade. And just looking at it top down, the healthcare companies, if you plot a chart of technology versus healthcare since the pre-GFC all the way up until now, you would see that healthcare companies are now the cheapest they've been against technology companies, going all the way back to just before the GFC collapsed. So there's all these kind of what seemingly coincidental things, but it's telling you that one, the market hates the sector for whatever reason. Could it be Trump, RFK, whatever? There's always a reason. Could it be that there's more focus on technology companies? Whatever the reason, these things are generally cheap. And we're also finding at the same time that through our bottom-up work, technology companies are expensive. The other time I remember being a young tech analyst during the dot-com days. The other time we kind of had that sense was during the dot-com days. And guess what happened after that? What we don't know is what unsettles this. It could be the end of the AI trade at some point. Could be, I don't think it'll be valuations. We've passed the valuations. I don't think valuations matter at the moment. What I think investors are just buying things that are going up. Valuations, we can agree, don't matter at this particular point in time. It seems that way to me, but it will matter in the longer term. So at the moment, we're really kind of, looking away from the market or the benchmarks and deploying capital to cheaper areas. I hope that kind of answers your question. So as a result, there are companies that we've tracked for 10 years that were never cheap enough for us, and now they are cheap enough, and we've done the work and we've bought them, and that's why we've got a fairly small cash allocation at the moment.
So you quickly touched on owning 2 Indian banks. So have you seen yourself coming more out of Europe and the US and getting into more slightly emerging markets, or was it just a one-off that you just own 2 Indian banks?
No. So I'm not sure what I mentioned last April. I don't recall the conversation fully, but I would have mentioned that China is one of those contrarian calls that I probably had at the time. And I said, China couldn't be more hated. There's some really cheap assets there. So we deployed 13-14% of our capital to China. AIA, we bought Hong Kong exchanges, we bought an air conditioning company, and a few other things. Antisport, which is a sport apparel company, focused on mainly consumer. We said, these are so beaten up, you'll get some interesting kind of development since then. We've taken some profit on those investments. They've done really well. But to answer your first question, are we deploying capital out of US and Europe? US, absolutely. It's the strangest market I've ever kind of faced, I can tell you. It's really strange. So in the US, quality growth businesses, which typically are the kind of companies we look at, are trading at very high multiples. In Europe,
Yep.
similar companies, so let's compare Caterpillar to a similar industrial business in Europe. The Caterpillar would be 2-3 times more expensive than the similar business in Europe. Same global businesses, but somehow it's more expensive. In Europe, on the other hand, European markets have done better than the US markets, but deep value stocks, so low quality businesses like banks, cement companies, those kind of things have done extremely, extremely well. They've gone from maybe being cheap to now being quite expensive. So it's almost like you've got this strange behavior in markets. So you have to you can't apply the same philosophy in both regions, if you like. So at the moment, we're out of US quality kind of names other than healthcare, where we find tremendous value. And in Europe, we're getting into the industrial businesses that are quality businesses that have grown for many years with great prospects at excellent value. So that's the positioning. We're less than 40% in US, say, approximately the same Europe, and we've got India and China on top of that.
Is Indian, sorry, I'm interested from a personal standpoint. Your exposure in India, is it mainly financials, or
it's
is
only
it
financials?
like a mixed exposure? Okay.
Yeah, we bought what we consider to be the 2 best banks. They've been growing 15% plus for a long period of time. It's a company that's hugely underbanked, huge population, as you can imagine. Economy is growing 5, 6, 7%, depending on the year. Do we see the economy going from 5 up to 0, like China, hit the brakes? There's no property boom. We don't see a situation where something breaks the whole economy like it did in China. So we think that there's longer term momentum to be expected here. And again, we acknowledge the risk that comes with investing in an emerging market bank. So instead of buying 1, we bought 2 just to spread the risk, just in case something we can't dig up happens to one of them. The other one should benefit and vice versa, but together they should grow in a similar pace.
Jay, do you have any questions?
I have so many. This is such an awesome conversation. I love how we ended up. I didn't expect some of those turns, but it's so exciting. Okay, so one was, what core values help your firm stay rooted in your process?
Okay, yeah. Look, one of the things is longevity of the people and longevity of the process, and the fact that the process has been tested from the GFC all the way through, I don't know, Fukushima, this and that, whatever, COVID, whatever's come our way. Even when we underperformed, we saw that as long as we stick to what we do, you come out the other end quite well. And I was thinking your thing about culture. I do think culture is extremely important. Not panicking, knowing that there's a framework in place that supports you when things don't go your way rather than punishes you. I mean, I think this is super important, to have this long-term culture that you've built over time. And you can even apply it to sports teams. I follow the Premier League in football. I don't know if you follow that, but I know that Manchester United will not do well no matter how much money they throw at the problem, but Liverpool will. So why? The difference is the culture. You can take a good player into Man United and he'll become worse. And you can take an average player into Liverpool team and he'll come out better. And why does this happen? Yes, there's a coaching staff and all these kind of things. But in the end, and you see on Man United, you've had 6, 7 coaches changing hands. In Liverpool, you've had 2 over the last 10 years. And the difference is the culture, I think. And the same thing, we have to have a non-blame environment in the team. We have to really scrutinize where we do make a mistake and why we've made it, and make sure that doesn't happen again and what we've learned from it. But I think a big part of this game of investing is psychological positivity and strength. And if you damage one of those two aspects, then you won't be able to see the opportunities when they come. If you're not, you have to be optimistic to invest. You have to be the world's biggest optimist. At the same time, you have to be the world's biggest pessimist. So it's this kind of dichotomy of things that you have to balance.
I'd like your opinion on
tightrope,
this.
definitely.
I think it's a bit of a paradox. Buffett and Munger were said to have said, or I believe they said something to the effect of, we'd rather take a good business with a bad management, or if you show, I'm sorry, if you show me a bad business and a great manager, one of them will keep the reputation, and it'll be the bad business. Yeah. But I find that ironic, based on, we take a great manager and a bad business, Berkshire Hathaway Textile Mills, great manager buys it out of ego, and then pivots based on the hero's journey. So I am curious your thoughts on the value of the hero, the value of the innovator, the value. Yeah, that's a culture that I thought of that when you said Liverpool versus the Manchester. And you talk about common sense and principles. Curious, both of your guys' thoughts on this.
I thought of Inter Milan, honestly, when Jordan.
I'm not going to
go. Who's going to fix Inter Milan, but sure.
Yeah, I'm not going to go the Italian league. I'll stick to the Premier League. It's a bit more explainable. But look, if I may first, Aleck, and you can, of course, chime in if I'm not saying anything that makes sense. I think management is important, but I think the momentum of the business is even more important in a way. So you can take, if for a small, again, there's always caveats, right? For a small business that has one or two or three levers to pull, a good management team is extremely important, right? Their decisions have a real impact immediately on the business. Okay, do I buy this competitor? Do I do this? And it'll change the course of the business very quick. And in the example you gave, that would have been the case. The bigger the company gets, the more the CEO, I believe, and I've never been a CEO of a big company, so I'm guessing here, sets the culture of the place. You know, what are the expectations? How do we achieve the expectations going forward? And that trickles down. So the way we assess that is what they've done in the past and how they're coping with crises. So we look at, when did this company have a difficult period? What did they do? We have all these checks and balances to see what the culture of the company is. So something like, you mentioned Novo Nordisk, Aleck, at the beginning, right? So Novo Nordisk has a 150-year history. They've successfully innovated through many, many years, and they've become one of two leading players in the treatment of diabetes. And then they innovated, and they've developed a whole new class of drugs in the weight loss area, right? So Ozempic, Wegovy, that came from them, and then Eli Lilly came on board. Similar way the diabetes franchise kind of developed over the years. So this is a company with clear history and pedigree. That is undeniable. The question is, did they drop the ball in what? Was it a major way? Was it a minor way? Have they tried to fix it? Can they fix it? That's the analysis. That's the juice that comes out of, are we good enough as investors and as analysts to figure out whether this is temporary or permanent? Is something broken in that business forever? Now, if you take current expectations of the business and you go forward 3 years, if the market is right, then the company is priced on less than 10 times earnings, effectively around 10 times earnings, which is typically what you would pay for the banks that I mentioned, what you would pay for a cyclical cement company, or something even a lot lower quality. So the market's decided this has become kind of like a Pfizer, it will never grow again. And so the real difficult, and given how much the share price has fallen, we see this as an opportunity. We say, okay, if we look at the history, this is undoubtedly a great opportunity, but is that going to be the case going forward? So we start analyzing, and if you get this right, where you get the culture of the company, of the potential for success, the culture is correlated to the potential of success in the next 3 to 5 years. If you have the right culture, the right systems in place, and then if you identify the right catalysts over the next 3 years, you should be paying a lot more than 10 times earnings for a company like Novo Nordisk, which has grown consistently for many, many years and continues to be expected to grow more than Apple, yet trading at a 30% of the price of Apple. So these are the opportunities that I mentioned before. And yes, these companies might have to drop somewhat, but sometimes what happens is momentum works both ways, on the up and the down. So some things that drop 30% actually end up dropping 60, and they shouldn't. And that's when we come in to assess that situation. So yes, especially in questionable battleground investments like Novo Nordisk, like others I can mention, then we have to be very cognizant of the culture, of the potential for turning things around. On the other hand, something like Adobe, for example, in the US, which is a wonderful business, which hasn't put a foot wrong in terms of the numbers. So if you plot the numbers, you say, wow, what a business. How is this trading so cheaply? But there's an existential threat to their business, which is AI. So you have to ask yourself, does this fall off a cliff at some point? And we've taken that side of the fence. We've said, even though the numbers and the history of this company and the culture says that this is a great investment, we have made a decision that over the next 3 to 5 years, they have more competition and an existential technological threat to their business. So there's no one short rule, but definitely studying these things can really matter.
Epictetus said, "Don't teach your philosophy, embody it."
Yeah.
I have questions about. I'm kind of scraping at this, but I recently had this wonderful polymath on the show, Dr. Ian McGilchrist. He wrote this 2-volume. I gotta move these letters. I didn't finish it
a
yet.
big book.
The Matter with Things. It's a 2-volume. You would love this,
Wow.
Jordan. You're a deep guy.
Yeah.
This 2-volume book, The Matter with Things. Okay, and one of the central
Yeah.
themes in this magnum opus here is about attending. It's like attention. What we value is reflected in where our attention is.
Mm-hmm. Mm-hmm.
It's like and so there, it makes me think what we see is, it's like two people could be looking at the same thing and they see different things based on what they value, who they are, and that somehow has a relationship with how they live. So I think of like the value investor ontology or the value investor philosophy, the narrative driving the value investors. It's like sinners don't want to hang out with saints, and saints don't much like sinners. If maybe unless they're converting one another. So I guess my question in this, like, or if you guys could elucidate the value investors, like how much of this game is about, as Epictetus says, don't teach the philosophy, embody it. You said longevity as a core value. How much of it is a longevity, staying forthright, staying in the game, wading the heavy seas, the heavy water. It's like that endurance book about the man that he saved all of his fellow sailors over a 2-year period or something. So I'm curious about longevity, and also the relationship with what that means for the relationship with investors. It seems it's not a transactional relationship. It's a relational relationship. There's like, I go to the shareholder meeting every year in Omaha to meet and yes, I get to meet my friend Aleck here, but I'm going there because I'm bought into a philosophy, and my patriarch is going to pour into me, and I'm the investor, they're the manager. We have this relationship, and this relationship matters because when the seas are parted, I'm going to be afraid to walk through those. As the investor, I'm going to be afraid to walk through those seas that are parted, at the fear that they're going to come back in.
It's not going to come back.
Yeah. So there's it's a 2-part thing. I guess, like, I don't know if I even have a question, and I do have questions in this. What's the relationship of the investors to the manager? What's your take on some of what I'm saying around value? The values, the core values of value investing.
I think I can deduce like what the three questions kind of are. One is, what conditions do you set yourself to deliver on the outcomes that you expect from the companies themselves? Are you doing something within your firm? So I'm a firm believer of alignment of interest. So as I mentioned before, all of our staff are shareholders in the business. So what they do and how they conduct themselves and what decisions we make matter for the long term of the business. The second thing is your relationship to clients. Well, my money is invested in the fund, so I will feel the pain and the gain, the good thing times and the bad times as much as our investors would. And I think that's very important. And same goes with our staff. They're not investing outside of the fund. They're not supposed to and not allowed to invest anywhere else but our fund. So this alignment of interest is important. And then I would say, with walking through that part at sea kind of thing, the way you do that, I think I was just thinking about what's an analogy of a process. For me, process is kind of like your moral guide, your moral code, if you like. I don't want to make it too grandiose. We're only talking about investing here. We're just investing money it's nothing super philosophical. Let's not kid ourselves. But
you nearly made him sound like Jesus, Jay.
Yeah.
This was
Party
this is
season.
that was the plan for the very beginning.
Yeah. Let's just
This is a
stick to
sponsored ad
Yeah.
for Pella Funds.
No, it's not. It's definitely not.
No, it's a joke.
Yeah,
Everybody, calm down. We're
I
having too
know,
much fun.
I know. So what I'm trying to say is, when you have a process that makes sense, and you should question whether your process makes sense. And for us, does it make sense when you're creating a fund? Does it make sense that your companies on aggregate should, if you're trying to beat an index, which is a random 500 companies, whatever it is, should your companies grow? If your companies grew faster than the benchmark, if your companies were cheaper than the benchmark, and I'm talking on free cash flow yields, and Aleck, you would know what I'm referring to here. It's not PEs or these kind of things. We're talking back to fundamentals, cheaper than the benchmark, producing more cash than the benchmark is this year. And is it high quality? And there we look at, are the margins better, return on invested capital, all these kind of things. Are they better than the benchmark? Then in the long term, you should expect that bunch of companies, if you've done the work right, you don't have too many pitfalls along the way, that should outperform in the long term, but it could underperform in the short term. So when you're facing a difficult period, when things don't make sense, we go back to the common sense and how common sense can be cyclical. And we're from our perspective of the planet and the world, we're in a bit of a dip in common sense when it comes to investing. Do you change what you do, or do you stick to that moral code, to that philosophy and process that you have? And for us, when the process still makes sense, then we just stick to it. And that's how we take that first step, across the dangerous waters, I'm going to call them. And so that's how we stick to the process. The other thing I would say that is paramount to investing, and I've said this to the team often, is dogma is the most dangerous thing you can have when investing. So it's dangerous to talk yourself into a situation where you think you know everything and everyone else is just foolish and they don't know anything. So sometimes the process can be dangerously similar to dogma. You want to make sure that your process is not dogmatic and it's allowing you to express your investment ideas in the widest possible range, but keeps a tab on those risks that you're taking and make sure that the long-term track, you're still heading from A to B. You might zigzag along the way, but you are on the same path. So dogma for me is, so for example, we talk about value, we talk about growth, but we bought NVIDIA a year and a half ago when we saw the first pop, and we said, we did the maths, we did the assessment of how many chips would have to go. We saw it was an arms race developing in the chip world, and we said, we're going for this. And then we didn't stop there. We said, if we buy that, we should buy Broadcom. If we buy that, we should buy a data center play. We bought Vertiv and Schneider. If we buy that, what's the next phase? We're going to buy cables, Prysmian, cable company in Italy. So we took that idea and we now deep value guys said, no, that's not for me. NVIDIA, oh, yeah, that's a bit rich. But actually, you could make a case at that point in time that it was the right investment because it was too cheap for what was about to come. But overall, yeah, so that is what I'm trying to explain. But now we've sold down NVIDIA. Yeah.
Couldn't underperformance actually be analogous to if a company is there could be seasons where a company is reinvesting into itself because based on its vision, based on its mission, based on its values, it's all sorts of factors. Like
yes, it can
underperformance.
be.
When I think of underperformance, I could think of it's all about capital flows, right? So if I'm making a bet, it's the timelines. My bet is later,
Yes.
I'm not going to see it until later. So like underperformance could actually be inverted value. I mean, listen, this might be a little esoteric, but just saying in my mind, like underperformance could have an inverted value, like metric to it, or
there's different types of opportunities, right? And Microsoft is something as an example to what you described. In 2000, when he was forced to divest and to whatever the situation was from a regulatory point of view, that kept it at the 10 to 12%, 10 to 12 times earnings for a long period of time. But if you did the analysis, you would understand that this is becoming like the Death Star of software, right? It was just gobbling and getting more and more market share. So if you recognize that, and Microsoft has been our biggest holding since 2015. However, in the last month or two, as I mentioned, it is no longer, not even in the top 20. But and that is unusual for us, I can tell you. But that is a period where you say, hey, something is changing here. It's underperforming. At this particular point in time, because the market, I'll go back to what I discussed about ETFs and things like that, because the market is not driven by fundamentals or valuations. It's actually driven by what we call flow in the industry. That means, for example, we have a stock in Europe. It has grown 6% without fail for decades. Right now, it grew 4-5% in Q1, grew less than 1% in Q2 because there was the tariffs, okay? And the stock is down 60-70%. Now, we find that a very interesting situation. And then you think, why is it down? Yes, it's had a weak quarter, but is this business broken? It's a specialty chemical business that has done really well. It's selling products that the world needed 3-5 years ago and 3-5 years from now. So you do the fundamental analysis and you say, why is it still falling? Then you realize maybe a Fidelity or a Capital, a big holder is halving their stake. People are shorting their stock because it's in some basket of chemical companies that apparently is going to do badly. So the world's become more complex from a flow perspective, but you have to see through that and say this is temporary because the selling will stop and the fundamentals will shine through again. And I want to be there for that. And that's why we're buying that business right now.
When I met my wife, she was my neighbor and girlfriend, and my stock was down, and now it's up like 60x.
60x.
I mean, she freaking made that investment of time. Jen is listening. Love you.
Okay.
I'm just saying.
Are you
way off topic?
Are you sending me her CV after this?
Yeah. Yes,
yeah.
I should.
No, we're definitely not.
If I was a stock, right? She saw something. That wasn't yet in the potential, and right, and like any great, I guess, board member or Charlie to Warren helped massage that boy into a man. And I'm not.
We don't do 60x's.
I'm not trying to get little weird, but no, but like I there's this element of that I think you're a great steward of, Jordan. Is the mindset, the dogged, or I want to say the indefatigability around having the process, having a purpose, knowing the core values of value. I think it just really is great for the pod, right? The Culture Matters podcast. That's what this is about.
And we don't change it. Yeah.
Yeah. So I wanted to highlight, you got me excited and reinvigorated. And Aleck, help me here before I start talking about my wife again.
I just wanted, honestly, like, I'm conscious of time and I understand where Jay's coming from. We kind of touched on it before. Jay kind of, in a really weird way, asked about CapEx cycles. we've actually
yeah.
had we've had no guest come on and explain a CapEx cycle to the audience. And he was touching on like the flows of capital, and he was doing the Karate Kid stuff with his hands and doing all that.
Yeah.
But after the global financial crisis, again, I go back to that, this was from the last podcast, you bought Nova Nordics and ASML computer chips, and you're talking about ASML.
ASML.
Yeah, I'm always horrible with that name. And you're
No
talking
problem.
about how much money they were spending and investing into themselves, and how they were quantum leaps effectively ahead of their competitors. Could you try to explain just how, obviously, when a company's spending for growth, it doesn't show up in their profitability today, but obviously as an investor, you're looking out multiple years and you're going, wow, the advantage that they're going to have when this actually works is going to be insane.
Yeah. Excellent question. And this is interesting topic because in the US, people are obsessed with buybacks, capital allocation. At the end of a meeting, they'll say, what's your capital allocation like? So they'll say, okay, buybacks, not many dividends in the US, and growth capex, right? And things like that. And they're obsessed with buybacks. Now, an example of a company we have, AIA, it's a life insurer in Hong Kong, right? Now, they come out every year without fail. They've been growing double digits non-stop, and they come out and they say, "Hey," and the analysts keep asking them, "What's your buyback schedule?" Right? And they say, "Well, we've got this opportunity to invest in our own business and get a return of whatever IRR of 30, 40, 50%, right? So we're going to invest in that, and the share price falls because they don't increase the buyback." Now, why wouldn't you encourage your business to invest heavily when they see an opportunity, right? You want to be rewarding them for that, not punishing them. So there is a culture at the moment, going back to how we've been accustomed to flow affecting the performance of share prices, and the bigger companies should buy a lot of shares, and there's a lot of pressure on these businesses to do that. But interestingly, in the US, when we bought NVIDIA, we said the CapEx numbers for the hyperscalers are wrong, right? We can't be right on the NVIDIA side, and the market can't be also right on the CapEx side for the Google, Meta, all those guys. One of them has to be wrong, and we said we choose to be right on this one, which means that CapEx has to dramatically increase for Microsoft and Google and Meta. And that's exactly what happened. And they weren't punished for that. In fact, they've been rewarded for investing so much in AI data centers. And the question now is, but that increases the risk, right? Now you're saying, I've got an assumption that what you've done is right, and you should get a huge return on this. But we've got no proof, no real proof, that there's a proper return on investment on all these AI investments that people have made. There might be. Have we overinvested? Have we underinvested? Those are questions that are very open. So funny enough, it can really vary. So I always prefer a company to invest in its own business. That's a good sign for me. When a company says, and the way we value a company is, we say, what is the free cash flow yield? We do it on maintenance CapEx. We say, how much, if I bought it outright as a private equity business, how much would I need to keep this business going? And then how much cash do I get back? But then we look at it, in order to get the growth that is the potential in this, how much do we need to invest? So we do it after expansion CapEx as well. We like businesses that invest more expansion CapEx. We look for those businesses, and we encourage it with companies that actually do a good job of it. Not once, for example, Intel, I mean, they've done a horrible job of it, and you don't want them throwing good money after bad, at more expansion. So short answer to your question is expansion CapEx good? Yes, it's paramount. And the bigger you are, the more dominant you are, the more you can assert your dominance by outspending your competitors. And we tend to, when we invest in a business, we intend to buy the business that's the leader, the winner within a particular sub segment or sector. So we like that. We think winners become even stronger over time. And if you get the right ones, it can really work.
Yep. I think we better wrap up close
Yeah,
to
I've
there.
got
I
a
think
million more
Jay.
questions. You're welcome back anytime, Jordan. It's always so
My pleasure.
enlightening. If you're listening to this podcast, I challenge you to go listen to season 72, episode 857. Very different conversation with Jordan Cvetanovski, but very complimentary to this conversation. I challenge, you could listen in either order. Aleck, thanks so much for doing this today. Jordan,
Easy.
it's really a
Thanks so much
pleasure
for coming
having
on,
you,
mate.
and I would challenge everyone to go to the Pella Funds website.
Check out
Just
website.
check it out. And this isn't financial advice, right? We'll add that in
No,
there. But as a passionate host, co-host, I do think you'll like the website, and I always learn when we have you on, Jordan. So thanks so much.
no, I appreciate your time and thank you for having me. Thank
Please
you.
Anytime,
share
Jordan.
this with a friend that loves investing or wants to learn more, and you know it. And we will see you next time on the Culture Matters podcast. Thanks, guys.
Thank you.